All right. So it's 10:30, so I will go ahead and call to order the Board of Trustees meeting of the City Employee Pension Fund Board, and this is a special meeting. And we do have a quorum, and I welcome everybody here to this virtual meeting. And the first item on our agenda is the minutes of August 30th, 2024. So I'll entertain a motion to approve and a second, and then we'll discuss them.
I'll move to approve.
Thank you.
Second.
Thank you. Is there any correction or addition or anything to the minutes that anyone has? All right, seeing none, all those in favor, please say aye. Aye. Any other votes? Well, I'm thinking that passed anyway. First quarter expenses is on page 4 of your packet. And we also have the letter of transfer. Or do we have the letter of transfer?
Yes, it should be on the next page.
Oh, there it is. Okay, yeah. Okay, do I hear a motion to approve the first quarter expenses? Well, that's for your information. We don't need a motion about that, but are there first any questions about the expenses before we go on to the letter of transfer? Does anybody have any questions? No? Quiet group today. Okie doke, let's go on to the letter of transfer, and I'll entertain a motion to approve. This is October through December. Do I hear a motion?
I'll move to approve.
Thank you. Is there a second? All right. Councilmember Svigny seconds. And now, is there any discussion about the letter? All those in favor, please say aye.
Aye.
Is anyone opposed? All right, that motion passes. Now, our next item is for your information only on funeral benefits, page 6. And, well, it's actually not page 6. It's page, let's see, I think the page has sort of got, it's page 5, right? This is for Barbara Lewis, who passed away on January 13th of this year, widow of Charles Lewis. Is that Samantha, is that a technical or a correct spelling?
That's a typo.
Susan, is it Lewis or Lewos?
It should be IS.
Okie doke. We'll correct that there. And that's for your information. And then that moves us to number 5 on our agenda, which is the audit findings. And Commissioner Hensley, are you presenting that, or?
Yes, ma'am.
Who is? Okay, thank you. That starts on page 7.
So we've included, we had a review by internal audit, and it's actually a co-review, and it had to do with ghost employees. So it actually wasn't a review for the CEPF or police and fire pension. It was a review for all of LFUCG, but it does pick up our retirees in that review. And included in that review would be a finding that we would have a way to be able to find out if we are erroneously paying benefits to individuals who have passed. This was finding number one. And so the recommendation from internal audit was that we obtain the master death files from the Social Security Administration and periodically review those files, particularly for those members that may have moved out of state, or for those that we may have lost contact with, to be able to ascertain whether we are maybe erroneously making payments. We have been in contact with the Social Security Administration. They were wonderful to work with. Long story short, we don't have access to those files as a municipality, but they did provide us with an alternative, which seems like a really good option. And we think that that's a really good idea, to be able to access those records and do a periodic check. In the time that has occurred, we actually have come across a situation where we've been notified that we have been direct depositing a payment for a member actually of the CEPF continuously to their account after a member has passed. And I guess that member's account was in a joint situation with another family member. And they were still receiving payment, did not notify us of the passing of that member for quite some time. And we have had to enter into a repayment agreement from that member. So I do think that the finding is timely. The cost for the overall review is about $3,500. That's an annual subscription. I don't think that cost would be fully borne by the City Employee Pension Fund. I think that would be something that we would need to share by LFUCG, City Employee Pension Fund, and Police and Fire Pension, since that's like a full review for the government. But I wanted to bring it forward to the City Employee Pension Fund, because that would be something that we would need the fund's permission to be able to check records against, to check the pension fund's records against that data. And, just to kind of discuss the finding and make you all aware of the situation that has occurred. I'm so sorry. Make you all aware of the situation that has occurred within the fund. The total cost that is being repaid is over $17,000. So the benefit amount was actually being paid for quite some time before we were aware of the passing of the individual. So it is something that we do need to put into place in one way or another, just to make sure that we're safeguarding the assets of the fund. And I do think it was a good catch by internal audit, and something that we do need to pursue as a check and balance for both this fund, our police and fire, and probably a good check for, ghost employees or employees that have departed the government otherwise as well, if we have payments to them.
Mm-hmm. And so our police and fire pension, so presumably each of the three entities would pay a portion of that fee.
Presumably.
And so do we need today to authorize? Well, we need to figure out how that's going to be divided up. Would it be a third, a third, a third to make it easier? Or would it be based on the number of people in the fund?
I was thinking, Mayor, it would probably be an allocated share based on members. Obviously, the police and fire pension has a much larger number of members that we check data against. So I feel like that cost would be a much higher proportionate share. But I think to be safe, if we wanted to say a cost not to exceed on this board, we could then, because obviously they haven't met yet. The Police and Fire Pension Board has not met yet.
Yeah. We meet next week though, don't we?
Yes, ma'am, we do.
Mm-hmm. So it's just the two, it's police and fire pension and city employee pension.
Those are the
Correct.
primary. I think it's possible that we could have some other LFUCG situation individuals that we would have a reason to check the database for. I don't know what that would be, for any reason that we would want to check it, but those would be the primary, the police and fire pension and the city employees pension.
I mean, aren't all of our other employees in a state pension?
Active, yeah. I
And
mean,
and we would not.
yeah, I wouldn't think
Be-
that that would be, I can't think of a reason. I'm just trying to give deference to the unknown.
Right.
So, Aaron, is it just basically a subscription? Is it an annual?
It is a
subscription?
subscription.
Yeah.
It's an annual subscription.
Yeah.
And it's not, it's really a massive data set.
Yeah. So I'm okay with making a motion to pay up to 1/3 of the annual subscription, and then let you guys work it out and figure it out.
Okay.
Is there a second for discussion?
I'll second that.
All right. So my question would be, then we'd be asking police and fire pension because they have a lot more members to pay 2/3, correct? Yeah.
Yeah. I mean, that's what I think if we as a board at least authorize up to 1/3, you guys present what you think is the right way to do it to them, which I do think it's probably more correct for them to pay more, but for purposes of the discussion, I think if we do it this way, then you guys can manage it.
Yeah. Are there other questions about the Councilmember Baxter? Excuse me.
Aaron, would this come out of our professional services line item, or where would this, what part of our budget would it come out of?
Wouldn't it?
Sorry.
Would come out of the fund itself.
Yeah, it comes out of the fund. But
Yeah.
you're asking budgetary wise where we take it from the budget, the pension
Yeah.
budget.
Yes.
We don't have too many lines.
I know, that's why I was like.
I mean, you could kind of
Yeah,
Finagle it, but
yeah.
figure
I
that
think,
out.
I think probably professional services is the most likely. It seems, yeah, I don't have sufficient budget to take it out of operating supplies. I
Yeah.
could do a small budget amendment if
Yeah.
you all would
No,
feel
that's
more
fine.
comfortable.
but we're only
Um,
talking like no more than $1,200 essentially, right? Yeah. Okay.
Yeah. What other questions are there? Anybody else have a question? And Aaron, would you say the total number again for the subscription? Was it 30?
It's around
3,000.
$3,500 a year.
3,500. Okay.
Yes, ma'am.
All right. Any other questions about the motion to pay up to 1/3 of the cost of the subscription? No. All right, let's take a vote then. All those in favor of the motion, please say aye.
Aye.
Aye. Is anyone opposed? Okay, that motion passes. I am really glad they found this.
Me too.
So, is there anything else, Commissioner, that we need to discuss on the audit?
No, ma'am, that's it. I do appreciate the assistance of law in getting the arrangement, the repayment arrangement done with the family and working to get that done very quickly.
Great. Okay. Thank you very much. All right. Next is our investment review, and we've got David Calvert with us. Welcome. And Allison Corbally with us. Welcome. And so I'll turn this over to you right now.
Very good. Thank you, Mayor.
Mhm.
I'm gonna see if I could share my screen.
And for the person that's doing the,
Okay. Can everyone see my screen?
Yes.
Mhm.
Perfect.
Is that what
Here's
it
an
is?
overall allocation and snapshot of the city employee pension fund. As of June 30th, 2024, the total market value was $35,493,808. And we saw an increase in the market value to $37,259,003 as of September 30th of 2024. As we've discussed in the past, the portfolio is divided up into two components. The one component is the liability defeasing portfolio. This basically matches and mirrors the expected benefit payments of the pensioners. And then the other component is essentially the excess, and we call it the return seeking portfolio. Overall, the allocation of the portfolio is approximately 47-48% in fixed income securities between the return seeking portfolio and the liability defeasing portfolio. And there is about 33.5% allocation to domestic United States equities, and then 18.2% in international equities abroad. As we've discussed previously, from an actuary perspective, the plan is overfunded. As of June 30th of 2023, it was overfunded by a magnitude of about 5.8 times. We should soon be getting the new actuary report. It comes right around this particular time of the year in late October, early November. And at our next meeting, we will update this analysis as of June 30th of 2024. In line with the portfolio snapshot, in basically number of dollars, the return-seeking portfolio appreciated by $1.66 million. This represents a total return of 5.5% for the quarter, and that compares to a benchmark return of 6.18%. So we slightly underperformed the benchmark. For the liability defeasing portfolio, it increased in market value by $225,000. There were approximately $116,000 in disbursements. Those are benefit payments. And the total return of the portfolio was 4.26%. Overall, very, very good, solid performance once again. From a 12-month trailing perspective, the return-seeking portfolio increased in market value by $3 million. It was a 22.72% total return for the 12-month period. That compares to a benchmark return of 23.45%. And then the liability defeasing portfolio increased in market value by $608,000. There were disbursements. Some of those disbursements was basically an intra-fund transfer from the liability defeasing portfolio to the return-seeking portfolio. That occurred during the month of June. And then the overall combined portfolio performance was 22.51% for the last 12 months. Very, very impressive numbers. Here is just a historical perspective of the total fund versus the blended benchmark. As you can see, the one-year return was 22.72%. And then I thought you would have just a short market update. This first slide just kind of summarizes the talking points over the next several slides. So I will just kind of go right into the graphics. Overall, the labor market remains strong. During the month of September, that was actually a above expectation number, with 223,000 jobs being created. If you look at the red bar, you would say, oh, why is the economy still on a very good footing? October was basically an aberration. The reason why that number is kind of being dismissed by the markets was that we saw two hurricanes that occurred. That disrupts the collection of economic data and employment data. And in addition to that, there was a very long strike with Boeing, the air manufacturer company. So basically, when the market saw this 12,000 increase in employment, they're kind of dismissing it, saying that that's not necessarily representative of how the economy is actually doing. The unemployment rate has ticked up from the beginning of the year, but it's at 4.1%. For the Federal Reserve, 4.1% actually represents maximum employment, because you're not going to have a economy where employment gets much further below 4%, because there's always going to be individuals transitioning from one region of the country to another, transitioning from another job. So 4% unemployment actually allows for people to and employers to actually find eligible employees. What we've heard anecdotally from many of our other clients is that there's been a long period of time where you couldn't find qualified employees for vacant positions. And that has changed over the course of the last 3 to 6 months, where when they are posting a position, there are actually qualified applicants applying for those positions. One of the key concerns in the economy remains inflation. The inflation numbers are coming down. The August report showed year-over-year inflation increasing by 2.5%. Since this update, we received the September report, which showed CPI increasing at 2.4%. And one of the stubbornly components of inflation remains shelter prices. Housing prices in both owner-owned occupied units as well as rents continue to be stubbornly high. And that's represented by the dark blue line, where shelter inflation increased 5.2%, while all other components of CPI only increased by 1% year over year. So in other words, shelter represent about 74% of the increase in inflation over the last 12 months. And until that number comes down, we're going to still see readings that are in the mid 2% range. So what does this mean for monetary policy and the Federal Reserve? The Federal Reserve elected to lower rates at their last meeting by 50 basis points. They are actually meeting today, and approximately about 2 o'clock, you're going to hear their next announcement. The markets are widely expecting, I think there's about 96-97% probability that the Federal Reserve is going to lower rates by 25 basis points, or 0.25%. The markets expect, and what the Federal Reserve is telegraphing, that over the course of the next 9 months, we're going to see potentially this rate cut along with another rate cut in December, and maybe anywhere between 50 to another 100 basis points of cuts through 2025. So by the end of June of 2025, we're looking at a rate in the neighborhood of about 3% per se. So here's some of the factors that we're looking at from a monetary policy perspective. We've actually seen not only the Federal Reserve, but other global central banks cutting rates. So this is a global phenomenon of lower rates. From an economic perspective, GDP growth here in the United States remains robust in the high upper 2% range. This is kind of the Goldilocks scenario, where it's strong enough growth that we continue to see improvements in the labor market. However, it's not strong enough growth that will basically fuel inflation. And on the inflation aspect, that's moved into the light green area. We're continuing to see costs to trend basically at a lower increased pace, but we're not going to probably see prices that are lower than they were 3 or 4 years ago. But the prices rising are at a slower pace. Financial conditions remain pretty stable. Yield spreads suggest that the economy isn't going to have any major stumbling blocks in anytime soon. We continue to see upgrades in the corporate sector, which means that it's like there's not as strong of concerns about deteriorating economic conditions. Consumers continue to spend at robust levels and support the overall economic strength here in the United States. And the labor market, as we talked about, has shown some signs of moderation, but this is actually good for the economy because it's not going to result in continued wage pressure increases. And then the last thing I'm going to talk about is just kind of a summary of the equity markets. There's a lot of data here, but it's basically divided up into four main categories. The top category is domestic equities. The S&P 500 index increased for the quarter by 5.89%. Year to date, so in 2024 through September 30th of 2024, the S&P 500 was up 22.08%. Very, very remarkable gains. On the international equity, when you look at the first line, you see that for the quarter, it was up 7.26%. So that outperformed the United States market. However, year to date, it's actually trailing quite substantially, with international equities up only about 12.99% compared to those 22% returns for domestic equities. And then fixed income, which is in the bottom third, the Bloomberg US aggregate increased by 5.2%. So bonds were definitely a diversifying effect where it actually allowed to post similar returns as domestic and international equities. However, year-to-date returns are much more muted because there's just only limited upside potential on fixed income securities. And you saw an increase of about 4.45% there. Now I'm going to turn it over to Allison to talk about the specifics of the plan. Unless there's any questions.
Before you do, yes, let's see if anyone has any questions on your presentation. Are there any? Okay, Commissioner Hensley.
I just had a quick question on page 8 of the presentation that has the return-seeking portfolio historical returns.
Yes.
And I know how greedy it sounds to be complaining about 22.72% return. However, we continue to underperform the benchmark, and I just was curious as to why.
Sure.
We like year over year.
I'll address that because it's part of the return-seeking portfolio. So the underperformance for the 3-year time period and impacting that period is really a result of the overweight that we took. The investment committee decided to take in the small cap area in U.S. equities. And that was right before the collapse of the regional banks that you had Signature Bank and Silicon Valley Bank. The issues in the region that impacted regional banks. So that overweight that we took impacted our returns. And so that was from an asset allocation standpoint, a decision standpoint that created the drag on returns for both the first quarter of 2023 and somewhat into the second quarter of 2023. I will say that from other periods, like for example, for this recent period that you're looking at, and we can talk about the performance if you want to go right to the performance page. You can take us there to 24, Dave, if you could move it to 24. Really, the drag in the performance is coming from our active manager selection. And that is on the U.S. equity side and primarily on the non-U.S. equity side. So, for example, in the U.S. equity, if you look at primarily, we've moved the portfolio to a passive exposure, but we do have an active manager, Von Nelson, which represents about 10% of the portfolio that has underperformed. That manager we are reviewing closely. And one of the reasons is while it has been unfavorable because its lack of exposure to some of the Magnificent Seven that have driven the market in the past 18 months, it still hasn't kind of chinned the bar on what we expect or what we anticipate they should receive for, or we should receive for returns from that manager, even though it is slightly concentrated. We've put it in the portfolio to be a good balance with our passive exposure. So that for the U.S. equity. And then for the non-U.S. equity, you're raising a very good point. Our active manager selection has not been, year to date, it has performed much better. Our quarterly return in the active manager space for non-U.S. equity, again, has not delivered. And with active, you are going to underperform at certain periods, right? Because you're an active manager taking on that risk. But really, it's not acceptable if you're going to underperform for a 2-year, 3-year, 5-year period for the portfolio. And that's when we have to take a closer look at these investment managers and to remove them from the portfolio. So I can say that we are looking at closely Von Nelson, moving them out of the portfolio, as we're looking now at more of a broadening market environment. So for 2024, and this is your recent period, and I know you're talking about 3-year, 5-year returns that have not been, particularly when you look at that 3-year return underperforming and the 2-year underperforming. We realize that in this most recent time period, the equities that have been favored are the large cap companies and the Magnificent Seven. We are seeing the broadening out of the market environment, something that on the market return page, if you noticed, the rotation is out of the large cap space and really has come to favor a broadening market. So you see small cap outperforming, you see REITs outperforming, you see value outperforming for the market, which is broadening. It doesn't, I'm on the same page that you are, that we're not delivering the performance that we expect to achieve and that you should expect to achieve in this portfolio, considering we're adding active managers and we should be outperforming on those various time periods. I hope I addressed your question, and I'm happy to have at least one of the investment committee members on the call for our next quarterly meeting, if that would be helpful, so they can address it in more of a detailed nature than I can address it, as they are the decision makers.
Yeah, I appreciate your response, and I think that was a very good and detailed response. I'm just hoping that we start to turn that around.
Yes, I completely agree. The other option would be to move it to a passive exposure and not take on the active risk in particularly potentially the international space. That is another option as well. It would certainly lower the underlying fees for the portfolio because you would move all passive. Some of the changes that we've made in the portfolio, specifically in the past couple of quarters, you noticed we've been pretty much neutral weight to the benchmark. And the reason why is because of looking for opportunities to outperform in various asset classes. But more importantly, I think that we still remain in the red on the geopolitical risks inherent in the marketplace. And it's not just as we've come through an election, which we see increased volatility, but also what we're seeing in the Middle East, as well as Ukraine and Russia, and now North Korea getting involved. Those are reasons why we've stayed neutral, but we have made some portfolio minor adjustments, and that is, one is removing some of that exposure to emerging markets. Emerging markets recently has performed really well, but there's still risks inherent in that marketplace due to the outperformance as of recent of China and India, and maybe valuations being too high. We trimmed back off of some of the emerging markets exposure and added a active REIT exposure into the portfolio. That is at the beginning of the fourth quarter. Why? The REIT market has performed is anticipated from a valuation standpoint and a fundamental standpoint, and because of the lowering of rates, better suited to perform. And so you get the small trajectory from the equity exposure, and then you get the payout from the dividends that are guaranteed from a REIT exposure. Those are two small adjustments we've made to the portfolio since the close of the third quarter. But we have not made a removal of one of the managers as of yet in the portfolio.
Yeah, I mean, I don't know how everybody else feels, but I feel like, if we're okay to pay a little more and take a little more risk if we're having those returns, but if we're not, maybe it's not worth it. So,
Right.
Mhm.
I completely agree.
okay, thank you.
Yeah. Anybody else want to weigh in here before we go into Allison's full presentation?
I agree with Aaron. And to be honest with you, like if you look at the last year, like that, I know that when that event was, because you brought that up before,
Mm.
you're overweight. And if you look at the last year, that shouldn't be the case in the last year. Like, and I think you even made a correction with your person. So I would agree that you're lagging.
We are, yeah, and we should be outperforming because the returns you're seeing here are net of fee returns, and we should be outperforming, net of fee versus that benchmark. So I would propose either we have someone from the investment committee team join the meeting next quarter, and then potentially have the conversation of transitioning maybe some of this portfolio to passive, and then in addition to that, making some fee adjustments as accordingly to align with that.
What's everybody think about that?
I mean, that's a lot to throw out at once, but happy to go over it in more detail.
I'd be interested at least in making sure that we have the conversation.
Yes.
So.
Yeah.
Yeah.
Does everybody agree? So, Councilmember Fogle, did you have a question? You're gotta unmute.
I live in mute land, but I was giving a thumbs up to what Dave.
Oh, okay. I'm
Councilmember
sorry. I thought
Siddiqui
you.
was saying.
Very good. I'm sorry. I thought you had your hand up. So can you go ahead and set that up, Allison, to have someone at our next meeting from the investment committee?
Absolutely.
Okay, that'd be great.
Thank you all.
Thank you. Anything else before we move on to Allison's presentation? All right. All righty. If you want to go ahead.
I guess I'll move it since we did cover the performance. I'll move it to page 29 if that's okay with the committee. And this is a revisit of your exposure in the portfolio. I already mentioned that we've remained neutral through the third quarter. You're going to see a bit different in the fourth quarter as we've made some adjustments, small adjustments, minor adjustments to the portfolio. And then as you turn to page 31, Dave, this highlights what we're paying for the underlying managers. And Aaron, if you know on that international equity, the fee is a higher fee for the active management, which we've noted is not delivering. And so the thought would be after discussions, and we can continue to review, if you were to look at moving toward just a market exposure, that would lower the fee, considerably. In all aggregate, you're paying about 53 basis points for the exposure in the portfolio to the underlying managers. Any other questions before I turn it over to Dave?
Anything else? All right. Thank you very much.
Thank you, Mayor.
Just from the liability defeasing portfolio, we made that significant shift in assets from the LDI portfolio over to the return-seeking portfolio. So as of September 30th, the market value was approximately $5.4 million. It's generating a yield to maturity at market of about 4.2%. And it's positioned so it provides for periodic draws. As we discussed earlier, there's quarterly payments that are being made to the beneficiaries. The asset allocation consists primarily of U.S. Treasuries, a small allocation to corporate notes, approximately about 31%, and then the money market fund balance represents those intra-fund transfers for benefit payments. And that's just kind of like the next couple slides just provides all those details, but not really much else to mention. So I'll turn it back over to Eric Gordon to conclude the meeting.
Okay, well, let's see if we have any final questions for either David or Allison. Right, so next meeting, we'll hear from one of the investment committee members and go from there.
I've got a quick question.
Yeah.
Is the, and I didn't go back and look at it. Is the liability defeasing portfolio, the balance compared to the actuarial liability?
Yes.
How much greater is it?
That's where it's like we have to kind of wait until the October, the actuary report for June 30th
Okay.
of 2024 comes out. So there's kind of a mismatch that I'm showing September 30th of 2024 compared to June 30th of 2023. So
Okay. All right. So we'll see that next time. Okay.
yes. Yeah.
All right.
Okay. Anything else? No? All right. Well, we thank you both so much for that, and we'll look forward to next meeting's reports. We have one more item on our agenda, and Samantha, do you want to update everyone on our news about,
Sure.
yes, about a new pension board member?
Yes. So this year was our regular retiree election. We had two members nominated who are here, Ms. Lang and Ms. Summers. And the third position was actually vacant. So we were able to enact what we passed last year, the alternative election process. And I reached out to the beneficiaries, and unfortunately, I got no response from anybody. I understand also where we have gone virtual, that can be a little hard for some, just as getting downtown can be hard for some. So this means that we went to our next step, which is the opportunity for the mayor to elect someone of her choice to fill the board seat. So that is where we are, I believe.
And you all will remember we recently changed that. Has it been a year ago? I've kind of forgotten when we did it. So we did it at a good time, because you'll remember we did it because we recognized we were having fewer and fewer beneficiaries and retirees who could serve. So I am going to be seeking a new pension board member. If you have a good idea for a recommendation, let me know ASAP, because I want to go ahead and get that position filled. And it literally can be anyone who I would say lives in Fayette County. Is that fair statement? I mean, we didn't specify they had to live in Fayette County, did we? But I think it might be more appropriate. So that's who I'm looking for. So I will hope to have that done soon. So
and it pays really well, right?
It
Mayor
does.
Gordon?
In fact, we'll double the pay. Right? Oh my goodness. Well, I do, speaking of all this, I do so appreciate you, Charlene, and you, Gay, for hanging in there with us and serving again. So congratulations on your re-elections. And I hope to have someone on board for our next meeting, which is, let's see, January 28th. Is that right, Samantha? January 28th. And G will be in our city's 250th birthday by then. So, and I want to thank Councilmember Fogel for serving. Yes, she'll actually be going off. And I know it's been a good experience for you. And we all learn a lot from these pension boards, don't we?
Yes.
Yes. So thank you very much.
Thank you all for having me. And hopefully, as we continue to look for diversion, inclusion, and equity, folks will roll on. I'm a little smarter than I was. I know some different terms than when I came here. And so thank you all. And the
Thank
company
you.
was fantastic. That
Yes,
was the biggest part of it.
yes. Well, thank you. We appreciate your service to the board. And is there anything else for the good of the whole? All right, well, I'll entertain a motion to adjourn then.
So moved.
Second,
Thank
Let me
you.
get
All
that
those,
last one in.
yes, you
Go
do.
Cats. The women play tonight. Go Cats.
All those in favor, say aye.
Aye.
All right, we are adjourned. Thank you so much, everyone. Appreciate you.